Happy New Year. This is Tony at mymortgageguytony.com with a mortgage rate and housing forecast for 2023. And to kick things off, I want to talk first about where rates come from, because no doubt you heard over the last year, the Fed seemed like they were raising rates every single time that they met. And I would constantly hear people talk about how mortgage rates have gone up, which in fact they did. But the correlation between the two oftentimes is misunderstood. So when the Fed increases rates, they're increasing the Fed funds rate or the overnight bank rate, and that directly impacts credit cards, car loans, lines of credit, things like that, short-term financing. The fact is that what they're trying to do is help mortgage rates. They're trying to slow the economy so that inflation comes down, and mortgage rates always benefit when inflation comes down. So long-term financing is always going to track with inflation. When inflation goes up, which it did at a rapid rate, so did mortgage rates. And here's the reason why, is because mortgages are pooled together and they're sold off as a bond. And if you think about a bond for an investor, they get a return on this investment over a long period of time. So their biggest enemy is inflation, because that return erodes with inflation. It's not worth as much. So as inflation goes up, rates have to go up in order for that that return to be valuable to the investor. So just to kick things off, I wanted to talk about where those rates come from and jump into what's going on with inflation to see what's going to happen in 2023. So let's do just that. Let's get into the numbers here. 2023 forecast here, rounding out the month of January, but heading strong into 2023. Let's take a look here at what drives mortgage rates. So as we take a look here, I'll move my face out of the way. What we see here is this line right here is inflation. This right here is mortgage rates. Now we can see as inflation comes up, mortgage rates come up. As inflation comes down, mortgage rates come down. Now, what happened during this period of time is what's called quantitative easing. And this is going to play into our forecast here a little bit later. But you can see that the Fed kept the rates here in the threes by buying more and more and more mortgage-backed securities. So even though inflation started to ramp up pretty aggressively here, mortgage rates moderated because the Fed was buying these mortgage bonds. But as soon as they stopped buying right here, you can see that inflation was continuing up, and so did mortgage rates. Now, when inflation dipped a little, mortgage rates dipped a little. When they started to climb again, mortgage rates started to climb again. Now, nearing the end of 2022, we wrapped up with some meaningful improvement in mortgage rates because of this inflation. So when we jump into what's going on in inflation, we'll see we rounded out the year, ended the year 2022 with 6% year over year inflation based on the Consumer Price Index. And this strips out food and energy, mostly because the Fed in their monetary policy, when they're hiking these rates to impact short-term financing, they're not going to impact things like food and energy. And so those get stripped out of this core number. Now, when we take a look at this, we start to see why there's an expectation that we're going to see inflation start to come down here in 2023. So what has been occurring is these most recent numbers, and by the way, December was released last week, week and a half ago, and that was at 0.3. So what happens is 0.3 replaced last December's 0.6. November 0.2 replaced last November's of 0.5, and October 0.3 replaced the 0.6, because this is the rolling 12-month average. That's a year over year number. And so as we start to see the Fed's interest rate hikes take hold, which historically every single time that the Fed has intervened like this and raised short-term interest rates, inflation has come down and mortgage rates have come down. And so we are expecting to see exactly the same things, and in fact have began seeing that already in December and in January of this year. So, but you can also see the inverse of that when we had like these numbers here, like July, these larger numbers replacing these very, very low numbers. And so it looked as though inflation was on this never-ending trajectory, but now we're starting to see how these lower numbers are replacing some of these higher numbers, and we expect to see that continue. Now, you've no doubt heard that we're either in a recession or we're heading into a recession. Now, a recession is defined as 2 quarters of negative GDP growth. We've seen that. There's arguments as to whether or not we are in one or not, but we're definitely on track with the indicators of a recession. Now, an inverted yield curve is a huge signifier of a recession. And what that is where you have short-term financing, the return on those yields larger than the longer-term financing. So essentially, you've got this 10-year less the 3-month. And the returns, I mean, if you think about it, if you're investing money over 10 years, that bond should yield a larger return than a very short-term investment. But that's not the case, and that historically has always predicted a recession. So back here, you can see, as it approached inversion, recession, inverted recession, inverted recession, inverted recession, and inverted recession, and look at where we're at now. Big time inversion. So there's an expectation that 2023 is going to be the year that we enter a recession. Now, what does that mean? Because as we look at mortgage rates and recessions, mortgage rates have always come down in a recession. Again, as recession, as the economy slows, inflation comes down, long-term financing mortgage rates come down. So we look back here in the 80s, mortgage rates went from 16 to 11.75 recession in that recessionary period. Same here in this recession, 18 to 13, 11 to 8.75, and most recently the 3.75 to 2.75. Just crazy low rates, but that was a recession indicated here in 2020 with 2 consecutive quarters of negative GDP growth. So what happens to housing? Because that's another big question of what can we expect in 2023 housing. Well, housing has always done really, really well through recessions. And part of that obviously is the supply and demand equation, the demand side of things increasing as mortgage rates come down. And so as you can see, these recessionary periods, we're seeing home prices moving upward through these recessions, with the exception of one, which was this whole global financial housing crisis of 2007, 8, 9. But notwithstanding this recession, every single other recession, we've seen home prices actually do quite well in these recessions. And a lot of that, again, has to do with supply and demand. So as we talk about supply and demand, we've got this home price moderation that can hardly be explained as a crash. There's a lot of people expecting there to be a bubble. There's not going to be a bubble. So over the last 10 years, real estate is up 115%. It's very safe investment. Over the last 2 years alone, we're up 39%. Now, nationally, we're down 2.5%. This is a price moderation. This is the pie in the sky numbers that we'd seen over the previous 2 years start to subside. But when we take a look at the local level, what we want to talk about is housing formations. So housing formations are defined as a new, like lights being turned on in a new residence. So people moving out of their parents' home, divorce will contribute to that, migration to the area will contribute to that, and that creates household formations. Now, household formations are going to indicate what type of demand there is for new housing. The supply side, we've been short on for a number of years. You can see actual homes being built is being seriously outpaced by the demand, which is going to continue to support upward price movement. Now, affordability is always talked about. Well, what do we define affordability? We're still within an affordable market, believe it or not, when you look at the definition of affordability as it pertains to real estate. So essentially, affordability is determined based upon median income and median home price. So basically, if a median household can afford a median home price with 20% down, it's still an affordable market. And that on this gradient right here would be at this 100 mark, would be the affordability index being affordable. Anything above 100 would be affordable. And you can see, we've moderated through the years, and this is certainly more expensive, as we've all felt, but it's still affordable relative to that definition. And when we look back to 2012, that was like the peak of affordability. If you remember back then, really coming out of that 2007, 8, 9 home prices. And so the important thing here is we're taking this Clackamas County, a median household income of $86,499 a year. That's full household. And we compare that against the median home price of $583,919. That is the equation for affordable housing. And so we're going to continue to see demand in housing increase. In fact, I think that there's been some pent up demand because of the demand softening when rates got really, really high. And now as we start to see rates come down, that demand is going to really, really climb as this pent up buyers are really going to come out of the, off the sidelines and start buying homes. So one of the big questions is median home price. What's the difference between median and average, and which one's the better number to use? Well, median is a more accurate number because it removes any of the fringe, the low lows or the high highs, and it gives you a more accurate number. So we really want to focus on the median home price. Prediction for 2023. We'll take a look. Housing forecast, because of lower inflation, because of a recession-like slowdown, very, very tight inventory environment, and rents still on the rise. We're expecting low single-digit appreciation for most of the U.S. and certainly within the Tri-County area here in the state of Oregon. We're already seeing a pickup in activity, and so exciting news for all of us that went through 2022. And then from a rate standpoint, some of the headwinds that we're still facing is this quantitative tightening. The Fed stopped buying mortgage-backed securities, but now they're kind of rolling off some of their balance sheet, which is going to impact things. Lack of foreign bank buying of treasuries and mortgage-backed securities. And then there's spending still that needs to be financed. And then some of the tailwinds, that are helping rates, certainly lower inflation. As we see that continue to come down, we're going to continue to see mortgage rates come down. And because this recession is likely, that's going to help pull rates down as well. And we should see, as a result, increased demand, and that is supportive of home prices. So 30-year fixed rate mortgages are going to move toward 5% here in the first half of 2023.